Wall Street just did it again. Stocks ripped to fresh highs while the real world still feels tight, uncertain, and exhausted. That's the event. The market is acting like a party, but the economy is acting like a warning light. And if we don't read the gap correctly, we don't lose a little money. We lose time, we lose confidence, and we hand our future to people selling hype. Welcome in. This is us, together, doing what most investors refuse to do. We're going to measure the madness instead of reacting to it, because right now the market is insane, and that's exactly why there's opportunity hiding in plain sight. Here's the first thing we need to admit out loud. The stock market is not a mirror. It's a betting board. Price doesn't tell us what's happening today. Price tells us what the crowd thinks will happen next. That's why we can get soft consumer vibes, sticky inflation headlines, messy job reports, and still see stocks levitate. The market isn't voting on your grocery bill, it's voting on a story. And the story right now is simple, seductive, and dangerous. Rate cuts are coming. AI will boost productivity. Earnings will grow. Everything will be fine. That story is doing heavy lifting. But watch this. When a market rises on expectations, it becomes fragile. Not because it must crash tomorrow, because the price is renting the future. And rent is due. Fact, we're getting violent swings. Interpretation. The crowd can't decide whether it's fear or FOMO, so we see a sell-off, then a face-rip rally. We see doom on Monday and euphoria on Thursday. That emotional whiplash is not random. It's a sign the market is crowded, stretched, and sensitive. Now here's the mistake most people make. They treat volatility like a signal to do something dramatic. They hit sell because the headlines feel scary, or they hit buy because the chart feels unstoppable, or worse, they freeze. They wait for certainty. But certainty doesn't show up in markets. It shows up after the move is already gone. So we don't chase certainty, we build a process, we don't gamble, we measure. Let's get brutally clear. There are only a few things that matter for us right now. 1, expectations are high. 2, valuations are not cheap. 3, the winners are getting all the money. 4, the downside risk is hiding in plain sight. If we get those 4 things right, we stop getting played by noise. Start with expectations. People keep asking, how can stocks go up if the economy looks shaky? Because the market is forward-looking. If investors believe profits will be higher next year, they'll pay up today. Even if the data feels ugly right now, that's not a conspiracy. That's how pricing works. But here's the trap. When we pay up for a future that hasn't happened yet, we create a cliff. If earnings deliver, the cliff becomes a ramp. If earnings disappoint, the cliff becomes a fall. And the fall happens fast. Because today's price is built on perfect enough. So we need to ask a sharper question than, is the economy good? We need to ask, is the market already priced for perfection? Because if perfection is priced in, even good news can be a letdown. Now let's talk valuation. Not vibes, not memes, valuation. Valuation is the price tag versus the cash the business can actually produce. And yes, the big picture looks stretched. That doesn't mean everything is doomed. It means our margin for error is thinner. Think of valuation like buying a house. If you buy the same house at double the price, your future return gets crushed, even if the house is still nice. Price is what we pay. Value is what we get. That gap is where we either win or get punished. Here's the uncomfortable reality. Markets can stay expensive longer than we expect. But expensive markets punish lazy behavior. In a cheap market, you can make mistakes and still look smart. In an expensive market, you can be right about the company and still lose money because you overpaid. That's why we need discipline more than predictions. Let's talk about the big valuation thermometer people whisper about but rarely respect. Market value versus the real economy. When the total market gets wildly larger than the engine that feeds it, returns get harder. Not impossible, harder. Because you're paying tomorrow's dollars with today's dollars, and that ratio has been stretched for a while, which is why people start saying, it doesn't matter anymore. That's the seductive lie. It doesn't matter until it suddenly matters. Like gravity on an elevator. You don't feel it while you're going up. You feel it the moment the cable snaps. So we act like gravity is real, even while the elevator is still climbing. And we stop confusing, it worked recently, with, it's safe. Now, here's another trap. Index highs make us feel protected. But an index is a mask. Under that mask, some stocks are thriving and some are quietly bleeding. So we don't buy blindly, we rebalance. We trim positions that got too big just because price ran. We add to positions that stayed healthy but got cheaper, and we keep one simple rule. No single idea gets to control our future. That's why position sizing is not boring. It's survival. And survival is what lets us play offense when the real discounts arrive. Now watch this. If the market rips higher, we're still in the game. If the market dumps, we have dry powder and a shopping list. But if we go all in at stretched prices, we lose the right to act. That's the real danger when it matters most. Now watch where the crowd is. It's not evenly spread. It's concentrated. A handful of megastocks are carrying the index. That matters. Because concentration makes the whole market feel safer than it is. If a few giants keep rising, the index looks healthy, even if the average stock is struggling. So we don't just ask, is the market up? We ask, what is the market paying for? Is it paying for growth? Is it paying for safety? Is it paying for a narrative? And if we're wrong, where will it show first? That's our risk question. Because risk shows up before the headlines admit it. Now, let's get practical. What do we do when the tape looks insane? We do three things. We keep buying, but we buy smarter. We keep cash, but we don't hide. We manage entries because price matters more than ever. We don't need 50 ideas. We need a few high-quality setups and a rulebook. Here's the rulebook. We lean toward businesses with real cash flow, not just adjusted stories. Free cash flow is cash left after expenses and investment. It's the best lie detector in finance. Earnings can be engineered. Cash is stubborn. So when a company says, we're crushing it, we ask one brutal question. If profits are up, why is cash down? Because that's where the truth lives. We also lean toward businesses with high returns on capital. That's a fancy phrase, but the idea is simple. When they spend $1, do they get more than $1 back? Great companies do. Mediocre companies burn cash and call it strategy, and in stretched markets, the mediocre ones get exposed. Next, we avoid the trap of this time is different. AI is real. Innovation is real. But a great story becomes a bad investment if we pay the wrong price. That sentence alone can save us years. Because hype turns intelligent people into impulsive buyers. We see a chart run and we assume it will run forever. But markets don't reward belief. They reward price discipline. So here's how we stay engaged without getting reckless. We build a watch list of quality names. We identify the price levels where the math becomes attractive. And then we make the market pay us for patience. This is where most people get uncomfortable because they think the only two actions are buy now or sell now. That's a false choice. There's a third lane. We can get paid to wait. And no, that doesn't mean we turn into a day trader. It means we use tools that fit our process. One tool is a cash-secured put. Let's keep it clean. A cash-secured put is a contract where we agree to buy a stock at a lower price. In exchange, we collect premium today. We're not predicting direction. We're setting a price we're happy to own. And we get paid for offering liquidity when everyone else is emotional. This is educational. We manage risk. Now, before the comments explode, listen. Options are not the problem. Uncontrolled behavior is the problem. Most people use options like lottery tickets. We use them like limit orders that pay rent. Different game, same market. Now, picture this. A stock is trading at 357. We love the business, but we don't love the price. We say, we'll buy at 340. Instead of placing a limit order and earning nothing, we sell a put at 340. If price falls, we buy at the level we wanted anyway. If price doesn't fall, we keep the premium. Either way, we didn't chase, we didn't panic. We turned chaos into a controlled decision. That is what adults do in markets. Now here's the loop most people miss. Why is this especially powerful when markets are insane? Because volatility inflates option premiums. When fear rises, people pay more for protection. And we can sell that protection only on stocks we already want. We're not selling insurance on a house we wouldn't buy. We're selling insurance on a house we're willing to own at a discount. That's the key. And that's why this strategy can help us survive the whipsaw. Now, let's address the elephant in the room. What if the market finally cracks? Good. We plan for that. We don't fear it, because a crack is where great prices appear. But we only benefit if we have dry powder and a process. So we keep some cash, not because we're bearish, because we're prepared. Cash is not dead money. Cash is optionality and lets us buy when the crowd is forced to sell. Now here's the part that will upset both extremes. We do not go all in because the market is up, and we do not go all out because the market is scary. Both are emotional. We scale. We average in with intention. We size positions like we might be wrong, because we might. And if we're wrong, we want to be able to stay in the game long enough to be right later. That is the entire secret. Survival first, opportunity second. Now let's talk about the insane feeling specifically. Why does it feel insane? Because the signals conflict. Inflation prints confuse people, jobs reports send mixed messages, rate expectations change weekly, and the media turns every data point into a dramatic fight scene. But the market only needs one thing to keep running. It needs earnings to hold up. That's it. Everything else is noise until earnings crack. So we watch earnings quality, not just earnings headlines. We watch margins, we watch cash, we watch guidance. We watch whether revenue is real or discounted into existence. Because if margins fall while revenue rises, pricing power is weakening. Fact, interpretation, the business is losing leverage. And in stretched markets, leverage matters. Now let's zoom into the part the crowd ignores. Valuation isn't just about the whole market. It's about what we pay for each business. Even in an expensive market, bargains exist. Even in a bubble, some companies trade reasonably. And even in a safe index, some names are landmines. So we don't buy the market. We buy businesses. We buy cash flows. We buy durability. And we demand a margin of safety. Margin of safety is the buffer between what we pay and what the business is worth. The bigger the buffer, the less our ego matters. The smaller the buffer, the more we must be perfect. And perfection is expensive. Now, let's make it simple without dumbing it down. A great business can be a terrible investment at the wrong price, and a boring business can be a fantastic investment at the right price. So we stop worshiping excitement. We start worshiping math. Now watch this contradiction. The same thing that makes the market feel insane can make us money. When prices swing, the crowd gives us discounts, but only if we're calm. Volatility is the market's way of transferring wealth from the impatient to the patient. So the question becomes, are we building a portfolio for dopamine or for outcomes? Because dopamine portfolios look exciting right before they blow up. Outcome portfolios look boring right before they win. Now, we need to talk about the narrative machine. Right now, AI is the narrative king. Some companies will genuinely benefit. Some companies will get re-rated just because they say AI on earnings calls. We don't hate the narrative, we just don't overpay for it. We ask, is AI increasing revenue? We ask, is AI improving margins? We ask, is AI reducing costs or is it increasing spending? Because if a company is investing heavily in AI but cash flow keeps falling, we don't clap, we investigate. Now there's another open loop we have to handle. What if rates don't fall the way people expect? That's the silent risk. The market is pricing a friendlier future. If inflation stays sticky, rates stay higher. If rates stay higher, valuations compress. That doesn't require a recession. It just requires gravity, and gravity is quiet until it isn't. So we position like that outcome is possible, not guaranteed, possible. That's the certainty ladder. Fact. Expectations are for easier policy. Interpretation. The market is vulnerable if that doesn't arrive. Possible risk. We get a valuation reset without a collapse in earnings. That would still hurt. Now, here's what we do about it. We avoid stretching for junk. We avoid buying profitless promise at peak multiples. We avoid loading up on the same crowded trade just because it worked last year. And we build around quality plus price. That's our edge. Now, let's talk about an example type. A cash-rich, high-margin business that throws off real free cash flow. A business with sticky customers. A business with pricing power. A business that can handle a choppy economy without begging for financing. When the market pukes, those businesses recover first. Because institutions hide there. And when the market rallies, those businesses still participate. Because they're real. That's how we win both ways. Not perfectly, but consistently. Now, I want you to do something with me. Not later. Right now, pick one stock you own, just one. Ask yourself, if this drops 30%, can I hold it without lying to myself? If the answer is no, we have risk we didn't admit, and the market punishes unadmitted risk. Then ask, do I understand how this business makes cash? If not, we're guessing. And guessing feels fun until it's expensive. Now here's the part where we separate ourselves from the crowd. We don't need to predict the next move. We need to control our behavior. So we set rules, we set position sizes, we set buy zones, we set exit conditions, we set a plan for volatility, because the market will attack our emotions. That's what it does. It's a casino designed to make us overreact, but we're not the tourists, we're the house. Now, 2 questions for you, and I want honest answers in the comments. What's one stock you're watching right now, but you refuse to chase at this price? And what would make you change your mind? Better fundamentals or a cheaper entry? Drop those below because the way we think as a group sharpens everyone's process. Now, one more thing. If you want more scripts like this, fast, direct, no fluff, subscribe. Just subscribe. We don't do hype, we do measurement. Now, we're almost at the most important idea. The market feels insane because it's pricing a future that may be too clean. But our job is not to argue with the market. Our job is to position so we can win if the market is right and survive if the market is wrong. So we stay invested. We stay selective. We keep cash. We use volatility to get paid. We refuse to overpay for stories. We remember the rule that never changes. Price is what we pay. Value is what we get. And right now, too many people are confusing the two. Here's the final warning. When markets are this euphoric and this nervous at the same time, the next move is usually violent. Up or down, violent. And the crowd will not be ready. But we can be. Because we have levels, we have cash, we have a process, and we have patience. So keep your eyes on cash flow, keep your eyes on valuation, keep your eyes on earnings quality, and keep your hands off the panic button. Because the moment everyone finally agrees on what's going on, the opportunity is already gone. And the next window, it opens the day the market breaks somebody's confidence. Don't let it be ours.